Hello and welcome to the Newton Knowledge Podcast. My name is Mark Singer, one of the partners at Newton One, and I'm joined today by my colleague, partner and principal of our firm, Stephen Target. Steve, how are you?
I'm great, thanks, Mark. How are you doing?
I am fantastic. The heat has settled down, so it's great to get out of your house and not be soaked. For those listening for the first time, the Newton Knowledge Podcast is intended to complement our Newton Knowledge webinars by providing meaningful content to our valued advisor community, and generally anyone interested in learning more about sophisticated insurance-related topics, focusing on estate planning and executive benefits. During our podcast, we focus our discussions on topical issues that will provide you with unique insight into the people, processes, and products that make our industry so critical. We will occasionally also highlight individuals who have been meaningful to Newton One and therefore have contributed to helping us serve our valued clients. Newton One is a national life insurance planning firm, delivering insurance solutions structured to help clients and their advisors engaged in solving estate planning, wealth transfer, business succession, and executive benefits challenges. We are a member of the M Financial Group, offering our clients access to the nation's most prestigious insurance carriers who develop innovative products available only through our network. Today, we will have the privilege to talk with Mark Lingerfield. Mark is a partner and managing director at MPI, a business valuation firm. He is located in their Princeton office. Mark's responsible for client service and business development strategies in the Mid-Atlantic region. Since joining MPI, Mark has determined the value of closely held securities of companies for a variety of purposes, including estate and gift taxes, income taxes, employee stock ownership plans, corporate and shareholder planning, and S-corporation conversions. Mark has been with the firm for more than 22 years and holds finance degrees from the College of New Jersey and Rider University. So to no further ado, Mark, thank you so much for joining us today.
Yeah, absolutely. Thanks for having me, Mark and Steve. Just to expand a little bit on that very nice introduction. Yeah, I've been with the company a little bit more than 22 years, originally as a member of the analytical team and running a team of analysts, primarily doing business valuations for gift and estate tax purposes. About 10, 12 years ago, I moved into more of a business development role. I actively work with new clients or existing referral sources to help them structure their estate planning transactions and get the valuations of any hard to value assets off the ground. The firm MPI has been in business since 1939, primarily doing valuations for gift and estate tax purposes. We do have a few other departments such as litigation support, employee incentive plans, and a few other groups along those lines, but the overwhelming majority of the work that we do is for gift and estate tax planning transactions.
Good. Well, Mark, thanks again for being with us. Let's jump right into it. As we all know, and all the listeners that are with us today also know, timing is critical. I mean, we're in a time and place right now where these valuations are really important. I know that you guys are super busy. We rely on you quite extensively when we're looking for valuations and appraisals. So let's talk about a couple high-level things first, and then let's dive into some actual case studies more specifically. And I guess my first question is really a general question, but how would somebody know that they need to reach out to you and MPI, and perhaps give us a couple examples of some projects that you've worked on at a high level?
Yeah, I mean, there typically is a transaction for the business owner that is on the horizon. That's why ultimately they would need some sort of valuation help from a firm like MPI. And that transaction could be intergenerational, meaning they're making transfers of interest in their business to either a trust or the next generation, some sort of estate planning transaction like that. And then obviously also you have an estate tax situation. So business owner dies and his estate has to get his interest valued in order to report for federal estate tax purposes. So those are the two most common transactions we get involved in, but other reasons could be business owner is starting to weigh his options about going forward. Perhaps there isn't family members or existing management that could reasonably buy the company. So we can work with the business owner to help him sort through all his options. Are there strategic buyers out there? Are there financial buyers? Perhaps an employee stock ownership plan, otherwise known as an ESOP. Is that a possibility for the existing situation? So there's a lot of different reasons why you may need a valuation, but typically there's a transaction on the horizon. Some of the projects we get involved in can be, very large, complex organizations like a professional sports franchise. We have a number of clients, that own major league sports teams, and we get hired to help them value their interest in the team for estate planning transactions. But then you have other situations like a relatively small excavating contractor that we're currently working on. It could be a totally different valuation analysis, but the objective is still the same. They're typically doing some sort of intergenerational transfer to the next generation or to trust for behalf of another generation. Then there's a number of other hard-to-value assets out there. Carried interest in private equity, venture, or hedge funds are a very large part of our business right now, as those are, if the timing's right, you can make a transfer of an interest at the early stage of that fund and value that interest at a relatively low value. Then other hard-to-value assets, fractional interest in real estate, or insurance policies, or promissory notes. So there's a number of different hard-to-value assets out there, and for the most part, we can typically help in those situations.
Well, it sounds like you can get very technical, obviously, in determining what the value is of a business or of an entity. We at Newton One, as you well know, always collaborate with other professionals. We bring in the best of the best to help us with engagements and projects. And that's why we would lean on you to make sure that you and your colleagues to make sure that we have the right numbers and the right data in order to do a proper estate plan. And I don't know if this is a fair question to ask or if this is too technical, but is it possible for you to give us some examples of different valuation methods that you might use?
Yeah, it really, the type of method that you use is really dependent upon the underlying asset that's being valued. So with a typical operating company, and I'll say a profitable operating company, we'll typically use either the market or income approach. And just at a fairly high level, the market approach is where we would go out and look for other either publicly traded companies or other firms that have been acquired in the same general industry as the subject business. Now, we typically like to do a second valuation approach, which is called the income approach. And there's different income approaches, but the most common is the discounted future cash flow analysis, where we work with management to develop projections for the business. And then essentially you bring those back to present value at a risk-adjusted discount rate. This approach is very important to us right now. As you can imagine, the pandemic has created havoc for a lot of companies out there, both on the positive and negative side. Obviously, several industries have benefited from the pandemic and several others have been decimated. So you really need to project the cash flows of these businesses out to when they expect to get back to normalization. Some businesses, it's taking, 1 year where maybe they're already back to normal, and there's several others that are going to be impacted more on a long-term basis. So it's really important to work with management to try to project when they can get back to normal. There's a few other asset approaches. The asset approach is an approach you would use for an operating company that may not be valuable as a going concern anymore, whether it's in bankruptcy or the analyst may decide that there's more value to the company dead than alive. So basically, you're looking at some sort of liquidation value there. For asset-based holding companies, we do a lot of family holding company valuations, whether it's holding real estate or securities or other alternative assets. Basically, we would work up the net asset value of the particular partnership or LLC, and then determine if there's any discounts associated with the subject interest that's being transferred. For example, if you're giving a limited partnership interest in a partnership that doesn't have any ability to control the operations of the business, there's some pretty significant discounting that can be taken to account for that. Other assets like insurance policies or promissory notes, there you're typically doing some sort of income-based approach where you're projecting out the cash flows and bringing back those cash flows to present value based on the risk of receiving those cash flows. So hopefully I wasn't too technical there, but those are the most common situations and valuation approaches that we typically use.
Well, we sit here today. We're in the second half of July of 2021. We've been talking about this for 6 months, and frankly, during the election, even last year, about potentially increasing income tax, capital gains taxes, corporate tax rates, and I would say, in our opinion, probable increases to the estate tax rates and reduction in any exclusions. So we're all pretty busy these days. I mean, the backlog of work is starting to pile up a bit, with the opportunity of our clients to also utilize some of the low interest rate environments to maybe do some intra-family loans. As we get to the end of this calendar year, before any changes are made, or even as they are being made, I understand that there's an opportunity to use a clause that's called the defined value clause, which, again, you're the expert here, so we'll ask you to give us maybe a little bit more detail. But as we understand it, this allows clients to complete transfers now prior to full completion of the underlying asset appraisal. And if we go back, and I've done a little bit of research on this, I see that there's a 2020 case, the Wandry decision, which gives a little bit of flexibility. Is that something that you guys are looking at? Is that something that may be helpful to clients as they're approaching some of these potential changes?
Yeah, it's a great question, and it comes up multiple times a day for me right now. You're exactly right. The estate planning industry in general is extremely busy, as folks are lining up to do some complex planning. I mean, I get asked all the time what's going to happen with potential tax changes, and everything you just listed is on the table. We don't know exactly where it's going, but the trust and estate attorneys that we work with on a regular basis are trying to motivate their clients to do some of this planning, and one way that you can do it is through a defined value clause. And basically what this does is allows the planners to complete a transaction essentially before the actual valuation is done. Right now, valuations can take a couple months to get done, and if there's real estate involved, you may have to get an appraisal of the real estate done. So there's a lot that goes into these valuations sometimes. However, if the planner appropriately writes the transaction up and defines value, basically what that is, they insert the dollar amount of what they are hoping to transfer, and then the number of shares, or the interest in the percentage interest in the business is determined after the appraisal is done. Mm-hmm. And there's a number of different ways that planners do it. We've seen it done a number of ways, but essentially what it does is it allows the transaction to be a completed transaction and gives the appraisers and the planners a bit more time to make sure that the valuation is done appropriately.
As you well know, we at Newton One employ some pretty sophisticated strategies, and one of the topics that comes up regularly is how do we create multiple generations of wealth? And as we know, there's been another recent ruling or some discussion about intergenerational split dollar programs, and specifically what's happened with the Morissette case. So a number of years ago, MPI, and Mark, I think you participated in this as well, you guys wrote a really good white paper on this topic on another client engagement that you had worked on. I believe that you had worked on, or perhaps it was just putting together a general fact pattern. But with the recent court ruling on the Morissette case, are there any takeaways for our listeners from a valuation perspective that would be valuable to hear about?
Yeah, I think the biggest takeaway from the case is just getting the appropriate language into all the documentation. You have your donors and donees. You need to make sure that there's no perceived or actual benefits that are sticking with the donor more than what you're hoping to do in the transaction. So there was some language in this case that where the donor and the donee each had a say as to if the policy could be canceled or surrendered. And the IRS wasn't a big fan of that type of language, and ultimately it was not a favorable outcome for the taxpayer here. So really, it's just making sure that that the language is written into all documents, to actually show what you're trying to accomplish and trying to take away any real power for the donor of such a policy here.
Yeah, I think one of our takeaways is that, we still believe that intergenerational split dollar is an opportunity to create wealth for G3, down from G1 perhaps, at least G2, generation 2. But, we just maybe need to tap the brakes a little bit and make sure that everything is done appropriately, and, bring in a firm like MPI to help do the valuation of what the gifts may look like. So we're still favorable with the strategy, and I think overall most planners would be as well. Everyone needs to take their time and do it the right way. I'm not suggesting it wasn't done the right way, but moving forward now we've got some different facts that we can insert in how we put together the strategy. So again, we're here in July of 2021 as we're approaching the end of the year and some probable changes. Is there anything that you're seeing out there that would be maybe unique planning opportunities, or anything that you see that would be helpful for people to hear about with regard to opportunities to do some work with MPI?
Probably the most unique, whether you call it an opportunity or whatever you want to call it, but is still the impact of the pandemic. There's still many industries that are, haven't rebounded yet. In a gift or estate tax situation, more often than not, the lower the value, the better for the transaction that's being considered. There's still a lot of industries that haven't made it out, out of the poor cash flow for their particular business for a variety of reasons. So there's still that opportunity for many industries, and you want to make that transfer, at the right time. For other folks, perhaps industries that are doing better. There's the tax situation in Washington, where, which we've already touched on a number of times. There will likely be something that happens, whether it's at the end of 2021 or into 2022. We're just not sure, but there will likely be something that happens. And like I said, a lot of planners are really trying to motivate their clients to get things done as early as possible. Several times you've mentioned how busy the estate planning industry is, and the sooner the better is what I can tell, or what I'm telling folks on a daily basis about trying to get these things done, because the industry is extremely busy. We're still obviously taking on work for 2021 transactions. We're a firm of about 60 people, so we can handle large volumes of work, but the work is certainly still coming in fast. So the sooner you can get the transaction decided, you can get in our queue or whatever appraisal firm's company queue that you decide to use. But it's important to get the process going quickly. I think the end of the year is going to be extremely busy for this profession.
Yeah, I agree. I think this is our call to action, right? We'd like to just make everyone aware that there's opportunities. There's probably some unique opportunities based on what's happening with current tax rates and valuation opportunities that will not be the same in most likely a reasonably short period of time. So let's get in there with all of our planners and get everyone sitting around a table and see what sort of opportunities can be created. So, Mark, I think that closes up my formal questions. Is there anything else you'd like to share with the group today before we shut things down?
No, I don't think so, Steve. Just want to thank you guys and Newton One for including me here. Much appreciated.
Super. Have a good rest of the summer, and we look forward to seeing you soon. Take care now.
Okay, thank you.
The material and opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please contact a member of our team.